All right. Hey guys, this is Lane from the Simple Passive Cashflow podcast. Please go to the website and sign up for the new start program. You can go to SimplePassiveCashflow .com/start to sign up for the newsletter there. And also remember the Hui Deal Pipeline Club. Today I've got Kyle McCorkle. How's it going, Kyle?
Going great. How are you?
Good, good. So Kyle is pretty much a carbon copy of myself, another industrial engineer turned real estate investor, still
That's right.
in the grind, right?
Right. Yep.
So I stumbled upon your website, ReallifeRentalscom. You guys should definitely check out that website. It was stumbling upon there, and I was like, man, this guy's putting all his numbers in here and rentals, and that's all the stuff that I don't do because I'm just like, man, it's just too busy. Like I haven't even done my last year's tax returns yet. I haven't had the
Yeah.
chance to even do the bookkeeping yet. So quite frankly, I don't even know how much money I made last year, which people think is like really crazy because they think, I'm an engineer, but I just don't have time for it. And I just don't kind of care. I mean, I kind of know how much I'm making. I mean, I see the bank account going up, but
Exactly.
yeah,
Exactly.
I mean, how'd you kind of get started with that website then?
Yeah. So, in my quote unquote real job, like you said, I'm an industrial engineering consultant. And so I spend a lot of time kind of helping clients understand how their workforce is performing. And as I got into real estate investing, I started asking the question, how are my properties performing? And so, like a good industrial engineer, I built myself a spreadsheet. And I've had that going for a couple years now. And people started asking me questions about, how are you doing this? Like, how much money are you actually making and stuff like that. And I was asking those same questions when I first got into real estate investing. And so this is kind of my way of kind of, paying that forward and sharing that information on a monthly basis to show exactly how each one of my properties are performing. And once I got the spreadsheet going, probably takes me about an hour each month. I basically do an export out of my bank account, plop it into my spreadsheet, and then it populates all kinds of pretty graphs.
Yeah, you probably know this book too. It's called The Goal. They make every industrial
Exactly.
engineer read.
Yep.
They make a lot of like, management read it, but it's this book, I think it's like a story. I
Yep.
quite honestly didn't even read the book. I just looked up the cliff notes on it, but it's essentially this story. He goes to a plant, a manufacturing plant, and they're like measuring all this random stuff. They're doing all this random stuff, and then they kind of lose sight of what's the freaking goal.
Exactly.
So it's kind of
Exactly.
like, I mean, why are we doing all this investing? Why are we tracking all these stats when in actuality, the only reason you're doing it is to make money? So
Right.
it makes sense to
Right.
track it.
Yeah, and when you go and you go to buy a property, and the first thing you do is you are supposed to run the numbers, and then you say, okay, this property is going to cash flow $200 a month. But really, what I'm trying to say is, if I estimated that it would cash flow $200 a month at the end of a year, 2 years, 3 years, did it actually cash flow $200 a month, or did it negative cash flow, or did you get 300?
Right, right, and that's where you and I really differ, because it's like my in after I bought these properties, a lot of the rents went up slightly,
Right.
but then a lot of the property taxes went up.
Right.
I don't pay that, so it kind of just goes up, and yeah, I mean, I just don't do it.
Yeah.
So I
Yeah.
really commend you on doing that. And again, the website is Real Life for Rentals. But let's get to know you a little bit better. First question we always ask all the guests is, how much simple passive cash flow are you making today, and how are you doing it?
Yep. And your definition of simple passive cash flow, can you tell me what you mean by simple passive cash flow?
So what that is like, I mean, I guess turnkey rentals. Today people make the argument that it's not really passive at all, but let's just call it what it is. It's not like you're flipping houses or doing something
Right.
crazy. Like, you're doing this on the side of your day job, and it's definitely a secondary thing.
Right.
Yeah. How many houses on average? How much much cash flow you're bringing in per
month. Yep. Yeah. So I think your definition is the same as mine. Because when I first got into this, I said, I want to invest in real estate so that I don't have to work. And it wasn't so that I wouldn't have to work my real job and then just pick up another job managing rentals. So I define my cash flow as the money that's coming in minus the money that's going out. And that's money that I'm not having to actively work for. So to answer your question, I'm making about 1,700, and that's pro forma, but it's actually it's also based on actuals, and I know that because I do the tracking every month. But that's taking into account the vacancy, maintenance, Capex, and management. And I do have 7 rental properties so far. I should say I have 7 performing rental properties. Actually, just bought another one that I'm doing a light rehab on. And like I said, that is passive for the most part because I have a property manager for each one of my properties.
Right.
So after I do that initial buy, after I manage the rehab with my contractors, and then I hand it off to that property manager, it's pretty much hands off at that point. So that $1,700 a month, I might spend an hour, total reading statements and, going back and forth with my managers, but really don't have to spend a lot of time on that.
All right. So let's dig into the numbers a little bit and, what kind of properties they are. I mean, because, at this point, we don't know if they're class A, class B, I guess what class of property would you say they are and where in the world are they?
Right. So when I live in Hershey, Pennsylvania, which is in central Pennsylvania. Great. Yeah, that's right. Smells like chocolate. So I bought my first 2 in central Pennsylvania. Really, for my first couple, I really did not know what I was doing. I just kind of jumped into it. Real estate seemed like it made sense.
Right. And even for a smart guy, it takes 2 or 3, right, to kind of get the hang of it.
Oh, yeah. I didn't know anything about any resources, or I wasn't reading the right books. I didn't know anything about bigger pockets. I wasn't listening to podcasts yet, but it just felt right. So I just started buying properties. Yeah. So my first 2, first one was a 4-plex. It's about 20 minutes down the road from me here in central PA. My second one was a townhouse. It's the 4-plex is it's probably a B class.
Yeah. What were the rents per unit on that one?
Those started out at $550 per unit, and they're all 1 bed, 1 bath, just no frills apartments. I did when I bought it. I thought that it was under rented, under market value. So I've been working with my property manager to raise those all up to $625, which I think 3 out of the 4 are up to that $625. So it's definitely cash flowing much better than when I first bought it.
Yeah.
So we got the B class 4-plex. Then I have an A+ class townhouse. And it's way too nice to be a rental property. But when I first
were you able to hit the 1% rent to value ratio on that one, or?
No. And like I said, I didn't know what I was doing at first. I was just it looks like it'll cash flow, but I didn't know how to do a cash on cash return or anything like that. And looking back on it now, I'm kind of kicking myself because I'm I got a lot of equity tied up in both those properties.
Yeah, but it's cool. I mean, you got you started and it's a hell of a lot better than the stock market.
Exactly.
Yeah.
Right. So I got the A+ class townhouse. Around that time was when I started to get educated. I started to learn about the 1% rule. I started to learn about how to set a cash on cash target. And what I found was I was having a lot harder time finding the right deals once I put them through that 1% filter, once I put them through that cash on cash filter. And so I started to get impatient. And then that's when I switched to buying a couple turnkey properties. So I decided to go to in Indianapolis and bought a couple turnkey properties out there. I bought them.
And what year was this? So people can get it.
Was, I want to say it was 2016.
Okay. Yeah, that was kind of when I was buying out there too, and it was a lot different than today.
Yeah. So the one's like a B class, the other one's A class. For the most part, they've been awesome. And then I actually bought another one in Indy. It was kind of a wholesale deal, and then I tried to do the long distance rehab, and I really didn't like doing that. But I love my manager out there. I think he's the best manager that I have, and I feel like I have a better handle on what's going on with those properties than I do with the ones that are 20 minutes down the road.
Yeah, I'm gonna have to hit you up for that guy, because my PM just got a lot busier because a very high profile famous turnkey provider turned out to be a scam artist, and they got flooded with all their inventory. So
okay.
Yeah, we'll chat after.
Yep, I can definitely hook you up with that guy.
Yeah, so in terms of like the overall numbers, you got a little spread of all different kinds of things. You've got a couple, quote unquote mistakes, even though you're making a lot of money with the A-class rental. But for the most part, maybe let's just do it. You and I can do like a sample example for people buying that prototypical $1,000 rental property a month, rental property, about $100,000.
Yep.
What would, maybe break it down, like how much you'd be going to vacancy, how much you going to maintenance, Capex, and management, just off the top of your head?
Okay. So I would say, and are we considering this to be a turnkey property?
Yeah. Maybe class B minus. If it was a broker telling you, because they always lie, it'd be like a A minus in their opinion, but legit B minus property.
Yeah.
Depending which way the wind blows, maybe a C minus too.
Right.
C plus, yeah.
So I would say if it's a B or a C class property, you would definitely expect there to be a decent amount of maintenance. But the way that I remember it is, so you take your $1,000 rent, and then I break down my expenses by the acronym VIM-TIM. So vacancy, insurance, maintenance, taxes, and management. Right? Haven't missed anything. So with vacancy,
well, you get your Capex too, and is that in there, or is that kind of separate?
I generally lump Capex in with maintenance. So I'm not sure if it's the right thing to do to kind of like break that out separately. But I mean, when I first got into it, I just thought I got money coming in, I got money going out. So it's maintenance, whether it's fixing a plumbing issue or putting on a new roof. Like, to me, it's just maintenance.
Right.
All right. So for vacancy, I would do 1/12, so which is about 8%. So 8% of 1,000 would be 80. And then for insurance, I would say on a $100,000 property, depending on where it is, might be $700 or $800 a year.
It's kind of hard to go off like a percentage on that one because it's so small.
Yeah. So let's say it's 800. So whatever 800 divided by 12 is, what is it, like 60 or 60 or 70?
60, $70 a month.
Yeah. So let's call that 70 a month. Maintenance, even if it's turnkey, I would use at least 10%. I think a lot of turnkey companies would tell you less, like 5%, but I like to double that, especially if it's an older property. Like if I'm doing, I've been doing some brand, like basically gut job rehabs locally, and I still budget 10% maintenance.
Yeah. What's your
Um,
thoughts on like the data of the home? Is there any more older home, more maintenance, newer home, less maintenance, or even any, is there any even correlation there in your opinion?
I think there's definitely a correlation. Like my A-class townhouse, I have zero maintenance on it. It was built in 2008, I think. Um, Actually, it might have been 2011, but versus like some of the houses that I'm buying now are 120 years old. Um, and there's so many more things that can go wrong.
Right.
Plus there's a different type of tenant who's going to be a lot tougher on the property.
Yeah. Yeah.
So yeah, I would if it's an older property, like I would say 50 or more years old, definitely budget 10%. If it's less, maybe budget for less, but I would never go less than 5%.
Right, right, right. Yeah, I mean, with single family homes, I don't really have a clue how to really model it. It's so like all over the place, but like,
It is.
yeah,
Yeah.
yeah. I mean,
Yeah.
apartment homes, the way, the thought is, that's people always ask like, well, why do you sell in like 5 years? Well, like, you buy a 1980s property and you get and you turn it into you only have so much value you can get out of that building before like it just totally goes like, not very useful. It becomes an old property nobody wants to live in. So
Right.
the idea is take it from like a 19, it gets built and then it gets old 20 years to a 1980s building, and then we buy it, get back up that C curve and take for that one last ride.
Right.
Once you take a
Right.
1960s property, I mean, it's kind of on that last leg. You just want to get out at that point.
That's true. Yeah.
But I think houses, I mean, look at the stuff in like Cleveland, right? All that 1900s built stuff. I don't know if
Yep.
it's quite the same, but that's why I'm kind of selling all my single family homes, because I feel like at some point you're gonna have this huge Capex tidal wave coming, just take away all these gains from the years ahead.
I completely agree. My kind of the way I've been looking at my single family homes is I don't want to hold them for too long. I want to hold them for maybe 5 to 7 years. When I buy them, I want a new roof, I want a new furnace, I want new everything, but I don't want to hold it for so long that my seller is now going to say, "Hey, can you put on a new roof? Hey, can you put in a new furnace? Can you put in a new whatever?" I want to sell to that primary home buyer because they're going to pay a lot more.
Right, right. And if you think a lot of these, the life on these things, and I've got like a Capex chart, how long these long-term systems have. You guys, I think you
Yeah.
guys can go to the website and download that. But I mean, you look at some of the longer term components like a roof, like 20 years. I mean, if we're going to go off what you're saying, if the buyer is smart, they'll be like, okay, 10 years is the half-life on this thing.
Right.
You've got to sell it before that period to have a really good justification when you go to that negotiation table. It's like,
Exactly.
no, dude, this thing is 8 years old. More than half of the life is here.
Exactly.
Yeah, give me a
Yeah.
break.
Yeah. Yeah. And, with you and me, we both know when you're buying a house, that's one of the things that you look at. Like, if you see that the roof is close to being shot, then you can go back to the seller and say, "Hey, give me $5,000 off the price to pay for a new roof."
Right.
And I do not want to be the seller, who has to pay for that roof.
Yeah, and myself sitting in the seller's shoes right now because I'm unloading on my property. I'm like, if you came to me and you're a reasonable guy, I'm like, sure, I don't want to fix I don't want to wait another 3 weeks to sell this stupid thing with a new roof, and maybe you bug out in some other excuse. I'm just gonna give you the $5,000.
Right.
The bigger and better things.
Right.
So exactly, that's how you need to be putting yourself in that mindset. I think when you're buying it, think about the sale, think about the exit strategy.
Exactly. Yeah. Begin with the end in mind. That's one of my
Yeah.
favorite quotes.
So I think I interrupted you there. Did we kind of get through the whole how you run the numbers there?
So we talked about, so the rent's 1,000, vacancy would be about 8%, so that's 80. Insurance would be 70. Maintenance, I'm going to budget for 10%, so that's 100. Taxes, taxes can really vary too, but
Yeah. I think
that might,
insurance and taxes, you just got to run it. You got to get the actuals.
right.
Call people, go to the website, figure it out yourself.
Taxes, I'm just going to say 100. All right. And then management. So I think one of the mistakes that some people make is, if a turnkey provider gives you a pro forma and they'll say, oh, we only charge 7%. So they would put in that management 7%, but there's a lease up fee. So every time you get a new tenant, you got to pay that lease up fee. And typically that's like a half month's rent, or maybe even like a whole month's rent.
Mm-hmm.
So I usually add a couple percent onto that as well. So if someone tells me 7%, I'm going to bump that up to 10.
Yeah. Yeah.
That makes sense.
And another thing, I don't know where when you go through a turnover, you're going to have a couple weeks at the very least of no prop or no tenant. And you're also going to be usually paying half the month's rent, or if you ever lower class rentals, you might be paying the first month's of rent. Some people, I model it in that property management. So I'll actually put it as 12% as my,
yeah, makes sense.
Or I'll stuff it in the vacancy, but you got to put it somewhere.
Right.
Just
right.
Something to be thinking of if you guys are doing the numbers at home. On average, how long are your guys staying in your guys' properties?
So I do notice a gigantic difference in the rental market between central Pennsylvania and Indy. Indy is crazy. Like, I think I just had my first couple turnovers in Indy. So my first 2 tenants stayed for 2 years. And then I have a tenant in there on like a 3 or 4 year, some crazy, like long lease. But then like the crazy thing about Indy is it's like those turnovers so fast. Like there's so many tenants looking for properties. They're willing to pay high rents. Like I feel like I should have raised the rents like $100, because there's just so many people looking for good places to rent out there. Versus here, it's like you wait a couple weeks and then, we finally got someone who wants to live there, and their credit score is 450. So it's just it's such a big difference out there.
Yeah, I see my guys staying usually about a year and a half on average. But here's a industrial engineering question for you. The distribution is not like a bell curve. It's not like, even like here's a year and a half. It's more like most people will stay just under a year. So very front loaded. And then it's like Poseidon distribution or whatever that is.
Right.
But there's a small cohort that will stay for forever, like 4 years plus. Obviously those are like the 20 of the 80%, or maybe even less, but those are like the golden tenants.
Exactly.
Is that kind of what you're seeing too, or is that kind of just amongst what I'm seeing with my small sample size?
Yeah, so I've had a turnover in every single one of my units except for 1 or 2 of those 1-bedroom units in my very first property. And honestly, I think that like long term, I think having more of those small multifamilies with cheap rents, like with 1 or 2 bedrooms, and just people who like, they might be like a single teacher or something, and they just live there forever. It's awesome.
You would think it'd be the opposite way, right? I mean, when we model like apartment complexes, we usually like to see the 3-bedroom, 2 baths, 2-bedroom, 1 bath, because that's more indicative like of family. Yeah. But I can see what you're saying too, right? Like there's some people that are just going to be single forever.
And it's so easy to make, so easy for anybody. Well, it should be easy for anybody to make a $600 rent payment.
Right.
Versus like some of the people who are in these, single family homes where the rent is like $1,200. They like switch jobs, or like, can't work for some reason.
They're economic mobile.
Yeah. Yeah. Like I've had a couple of my single families where, that person if their car breaks down, all of a sudden they can't make that, $1,200 rent payment. But yeah, that's kind of why it seems like the $600, 1 bed, 1 bath, cheap, no frills, to me, I think that's part of my long-term vision, is to have a bunch of units like that.
Right, right. No, it makes sense, and it is a little counterintuitive to what the kind of the books tell you, but it does make sense.
Yeah.
Yeah. Oh, so if you guys want, I mean, that's kind of Kyle's and way he kind of underwrites the properties, which I think is great. I've got my calculator online, SimplePassiveCashflow.com/analyzer. If you guys want to get a hold of that, I have kind of footnotes too on each of these categories, but different ways to slice this thing, right? And I think single family homes are like and it's very, subjective based on where you're at. And it's hard. I mean, it's hard to get a good sample size of this too. I mean, had 11, Kyle's got just as much. And here's a couple of experienced guys, with a little bit different feedback. And that's why this single family home stuff is kind of all over the map.
Right. And honestly, like, I think it's important to run these numbers, and just get a number, and just see on average, will it cash flow? But here's the thing. If you buy 10 properties and you run these numbers and you say, okay, they're all identical, they should each cash flow, let's say 200 a month. One's going to cash flow 400, one's going to cash flow 300, 5 of them are going to cash flow, 100, and a couple are going to cash flow like right on the dot at 200. And maybe like 1 or 2 are going to be complete losers because there's something that you didn't know about, like you getting like water in the basement and something crazy happens. So, but I think the key is like, this is on average how you would expect that property to perform. And kind of like what you're saying, Lane, is like, when you buy a single family, like, it's a lot harder to predict how it's going to do. I definitely think if you buy multifamily and you have 300 units coming in, then kind of like that law of averages will kind of take into effect, within that one property.
Right. I mean, with 10 properties, I was kind of losing money on 3 of them, is what I kind of saw. That was kind of like the ups and downs. And
right.
I don't know how many you have to get to steady state, but if I tell, that was the kind of problem I was having when, I know you do some mentoring too, or mentoring too. And you have your buddy and he goes and buys a couple of these rentals. There's a pretty good chance that he's going to lose money and have to come out of pocket for some of these things.
Yeah. Yeah, exactly.
It's hard. It's like, what do you tell them? Like, sorry, man, you got unlucky. It's, 3 out of 10 lose money. Go on and buy a few more. Maybe you can get more lucky.
Yeah. I mean, you have to understand how the numbers work. You have to understand that, you're kind of taking a chance, and it's kind of counterintuitive, but you have a better chance of making money if you buy more because it's getting to that right sample size, because 3 out of 10, you'll lose money, but then 3 out of 10, you'll break even. And then 4 out of 10, you'll make money.
Right. So. Right. I guess like total returns, what do you say you're humming along at? I mean, you're making cash flow, but if you were to factor in appreciation, mortgage pay down, tax benefits.
Right.
How do you compare it to, because I know you do a little bit of stock trading, like you got to compare the two, right? Your return on equity.
Yep. So my total returns, based on the total that I have, the total equity that I have invested versus the total returns over the past 3 years, I'm at about 53%. And so it's 53 total. So if you divide that by 3, now I have been crushing it a lot more with my last couple.
Right. Because you're starting to do a little bit more hands-on, a little more burr, right?
Yeah. So if you divide that 53% by 3, it's 17.6% per year.
Yeah.
Which is pretty good. But yeah, I mean, once you get into the burr, you are kind of trading your time for those much higher returns.
Right. And you can't really equate saying, oh, I made like infinite gains, because you put in the sweat equity. You can't quantify that.
Yeah. I should say that I I didn't do any rehabs on my burrs. I didn't touch a hammer. But I did spend a lot of time managing those contractors and making sure they were on time, on budget. So it definitely took a decent amount of my time.
Right. So you're one of those investors that are kind of definitely experienced and going to take that next step. From what I see, I think most guys will go down the limited partner route into, bigger syndications. They more than likely won't be a general partner and kind of do that because they'll figure out they have enough.
Yep.
Another cohort is kind of doing what you're already kind of doing, is like the burr strategy, because they like, seeing the end product. And then another smaller group will do like non-performing notes. What kind of path are you heading? What's kind of where are you going to? Because you're certainly not going to keep doing what you're doing.
I'm not. No. I believe that single family homes is a way to get started. And honestly, the only reason that I'm doing it right now is because I'm building the equity through the burrs.
Right. Because it's like you're driving a car. It's like you're in first, second, third gear.
Mm-hmm.
It's the highest torque, highest acceleration.
Yeah. I feel like I can scale. So like the key right now is scaling my portfolio, scaling my equity, letting my equity grow either through debt pay down or through forced appreciation. But really in 5 to 7 years, when I'm ready to sell my single families, I'd like to 1031 those into those, like I said, those maybe fourplexes or maybe, sixplexes, 10 units, starting to scale up into those, 1 or 2 bedroom apartments. There's a ton of them around here. That's cheap. They're cheap rents. But basically using that equity that I'm gaining right now in my single families to scale up into those.
So more of like an A-class rental, or like just, nicer rentals? Is that, what do you mean by the condos?
Not necessarily nicer, just going from single families to buildings with more units, multi-units.
Okay. So yeah, the multifamily route, which, I mean, if you guys are listening at home, there's several ways you can do it. The mom and pop investor way, which is Kyle's kind of talking about, where you graduate 4, 8, 16, 32 units, or you kind of just go straight to the large stuff as either an operator, which is a general partner, or a limited passive. So kind of 3 roads down there.
Yeah. So I would like kind of my main source of income to come from my rental properties, but kind of like as you've talked about, I would like to, once we hit that $1 million in net worth, which is gonna be another 2 or 3 years, I would like to look into being, more of a, limited partner, in some of these other, more passive deals. Because honestly, that's the end goal anyways, is like,
Right.
Like I said, I don't want to be hustling for these, $100,000 properties, for longer than 5 years, I would say.
Yeah, I mean, I would say most times I would not agree with the people doing what you're kind of doing, but let's point out the obvious. You're an industrial engineer, which is like probably the best major education that for this real estate investing, and I mean, you have the experience, and your day job is kind of in this realm too, this whole management and change management. And you write freaking ReallifeRentals.com, right? Like, if anybody should be being an operator, you should. I mean, I talked to like hundreds of people, and I'm like, you're like in the top 5 percentile who should be doing this.
Yeah.
So I just want to caveat that for the folks listening.
Yeah.
If there's anybody, this is the guy who should be doing it himself.
Well, and the other thing I would add is, like I keep saying, I don't want to be the one doing the rehabs. I don't want to be the one who's actually managing the properties. I'm finding the right people to do that for me. And kind of like I said earlier, I'm making $1,700 a month off of my rentals right now, and I might spend an hour making that, $1,700 a month. If I were to be managing properties, I might be making, $20 or $30 per hour. But I realized that as an industrial engineer, I could go be a consultant and I'm making $75 or $100 an hour. So it's always just saying, I want to put in the least amount of time and make the most money. So as long as I'm raising my hourly rate in everything that I do, then at the end of the day, I'm going to be using my time, in the best way possible.
Right. Just keep your head down, keep working, but make sure that what you are doing has that higher hourly rate. I think that's
exactly
like you said. Yeah. And I think, like the young kids, they listen to this podcast stuff and they're like, well, I'm going to do multifamily because that's what everybody says. But I mean, take it from a couple of industrial engineers here that don't make $1 gazillion a year. I mean, you've got to kind of start with small stuff, right? And get this critical mass to a point. Everybody's a little different when that's critical mass is enough to kind of vault you to the next stage.
Right.
I mean, any thoughts on like what your critical mass point is to kind of flip the switch and go more passive, or?
That's a good question. What I would like to do, first of all, the first step is to build our cash flow. And when I say our cash flow, I'm saying my family's cash flow, so that we can pay for our monthly, just cost of living expenses. So paying our mortgage, paying for food, paying for daycare, or whatever. Once we get to that number, I would really like to kind of back off. And then at that point is where I start to look for opportunities to 1031 exchange my older single families into, these small multifamilies. But I don't envision myself kind of having to hustle as much at that point, because I've already got that simple passive cash flow coming in. So I would hope at that point I kind of like ease off the gas, maybe look into investing in some syndications as well. I would say once we hit that number.
Cool. So we'll kind of go through some of these questions that I'd kind of sent you back, and I can tell you're an engineer because you actually send me back a response and you write it out. Once we just lose the email.
Yeah.
So, we talk about this Han Solo moment all the time, and I guess it's kind of cool that I just saw the movie recently. They were just a bunch of lowlifes. But maybe talk to us a time when, like, you're working at the day job. I don't know how long were you working till you kind of found this stuff? What was like the trigger that finally made you, buy a rental and kind of write that check and just take a leap?
Yeah. So first of all, I love that it's this, you call this the Han Solo moment, because I do love Star Wars. So I will always remember this. I was, I still am. So I'm a consultant. And right out of college, I was this high-powered, smart consultant, and I was traveling all the time, like literally all the time. So I'd fly out early Monday morning, fly back like late Friday, and then get up Monday and do the same thing, and like taking red eyes and stuff, and like it was fine at first.
And it's cool, right? Because you're in first class. People are like, "Oh, what is this like 20-year-old kid doing here?"
Right. So I was doing that for a while, making lots of money, and it just kind of got to the point. I got married. We bought a house. We started to settle down, but I was still traveling. But I will always remember, I was flying back one night, and it was, Friday night, and I think I got stuck in Chicago, and it was like pouring down rain. I couldn't find a hotel room, and when I finally did, I think I got there at like 2 a.m. I did leave for my rebooked flight at like 6 a.m. I wasn't going to sleep, and I just got back to that hotel room, and I was just like, I can't keep doing this. Like, whether it's for a year or 2 years, I was like, I'm not gonna do this for the rest of my life. And then kind of the second thought was, well, what am I actually going to do? Because having a normal job, where I just kind of go into the office every day and, drive 30 minutes, sit in an office, and then drive 30 minutes home. It just sounded terrible to me too. So it's just like, what do I actually want? And that's when I started to really research like the idea of passive income and having my money work for me, and then the next step was having other people's money work for me. But I would say that was kind of the turning point, and I started reading, I started learning, and then maybe about a year after that is when I bought my first.
Yeah. Yeah. It's kind of, you and I are kind of the same age, and, other people that I meet that are kind of in their early 30s, it's kind of funny because we're all kind of dodging promotions, trying to make up excuses like, hey, Kyle, you're a pretty smart guy. You want to take that next manager role, probably
Right.
get you a director in a few years. And you quietly have to kind of just say no, or just like make up some kind of excuse. Like,
Right. So I've been saying that I've kind of like inside joke with my wife that I am the worst employee ever, because I just like, I don't want to get promoted. I don't want more responsibility. And so basically what I've changed with my job is I went from being a salaried consultant to basically being a contractor. So I still work for the same company, but more as a contractor. And so like, I don't work Fridays anymore. Fridays are meant for spending time with my son. So I take him on Fridays. I spend time on the business on Fridays, and then like I take as much time off as I want. Like right now, I'm off. I'm not getting paid. I'm talking to you, But I think that was the flexibility that I needed. The other thing that I did is I told them, now that as a contractor I can basically say no to projects. So I pretty much told them I'm not going to travel anymore. So I only take local projects now.
right. But it's not like you're useless, right? I mean, you still want to make change. You want to be in a high leverage position, but just, it's the ups and downs of that kind of that project. And when you've had too much, you say no.
Yeah, pretty much.
Yeah.
Yeah.
Something just occurred to me, I'm always thinking like, looking back on the first 10 years of my career, man, I feel so bad for that new kid that worked, there for the first 3-5 years. Like, don't you
Yeah.
want to just grab them at work one day and say, hey, listen to me, kid. Just, what the heck are you doing? Like,
Right. Right.
yeah. So currently, what are you kind of working on these days? Any 2-week experiment and a 6-month project that you're working on?
Okay. So I would say my 2-week experiment, this is the first time that I've done this, but as I've been trying to get more active and, kind of finding deals and stuff, there was a guy who posted on Bigger Pockets who's local. He basically said, hey, I'm a young guy. I'm looking to learn. If you're willing to spend time with me, then I'm willing to spend time kind of working for you. So I thought, hey, like this might be kind of a win-win. So I met with the guy, kind of like had him drive around with me. We checked out some rehabs, looked at a couple possible deals, and then I told him, hey, if you want to help me, I said, hey, I don't have a lot of time. You have a lot of time. So if you want to help me, if you just want to drive for dollars for me, which is basically you pick your target neighborhood and you just drive around and you just look for crappy properties. And you just write down the address, and then you either mail them or you call them. So he's kind of working for me on that. So that's kind of my 2-week experiment, I'll call it, because we'll see, if he's actually going to do it, and then see if I actually can kind of help to.
Yeah. I've actually been at that for like about a few months now. I made this cool Marvels trailer with this idea of crowdfund aloha, like sort of building an investment team.
Yeah.
But I get a lot of these guys, like they're super smart guys, MBAs, engineering degrees, like analysts. And I have a soft spot for like working professionals because they have all these skills and talents, but it makes no sense for them to kind of be like a Brent Kawamaki, which you guys saw on the last podcast, to go out and, you know, look for an apartment building for 12 to 18 months with no reward. Like, it's just stupid for like a guy making 200 grand to do something like that.
Exactly.
But if they were to somehow get involved with a team and do things when they would like, and something that's already going 30 miles an hour, they can just jump on. I think that's what they're looking for. But I'm kind of doing the same thing. You know, for me, it's more about character. And that's the whole reason why I'm doing this. I don't really need it for the money. I just kind of want to build a band of friends. So bring people on, teach them, trade them for a little bit of coaching for, these side projects, kind of how you're doing, and then see how they are. I mean, a lot of people are pretty flaky out there.
Exactly.
I mean, I guess I should have known better, but but it's kind of like Star Wars, right? Like, that's the theme throughout the movie. The Jedi Master teaches the student, and then the student usually goes crazy, like Kylo Ren, right? Like, that was part of the story that new Star Wars didn't show, but Luke had like a Jedi school, and that was when Kylo Ren went crazy and killed everybody and did all this other stuff. But I'm not saying that someone's going to come in and take all your knowledge, Kyle, and then take everything from you. Like, it's not going to be like a CrossFit gym where you have a trainer and then he's going to steal all your clients or anything like that. But you want to invest your time and not just have it go to waste too, I think.
Right.
Yeah, it's a 6-month project that you're working on. It's that bigger.
So my 6-month project is, I've been working on building a direct mail campaign. Because basically, and you were talking about it earlier, like the end goal is to get deals that cash flow. And, so for me, I think of it as different processes. So it's like a flow. So think about like a, manufacturing plant, and there's different processes. My bottleneck in my whole business is deals.
Acquisition, right?
Yeah. So finding those deals. So I've been, working on putting together a direct mail campaign. So I've sent out postcards to absentee owners, with a certain amount of equity in the property.
And this is locally for you?
That's local. Yeah.
Okay. So what's your simple passive cash flow number that you're kind of shooting for in your head?
Yep. So we're shooting for about $6,000 per month. And that's based on the amount that we would need for both myself and my wife to not work. Now, I think that number would probably move up if and when we buy a new house, if and when we buy a lake house, which is kind of one of our longer term goals. And then if we have more kids, which we will. So we're going to have to move that number up.
So like, imagine you had 2 times that, just so you get a little bit more cushion. What would that buy for you guys?
Right. So we would both not work. We would spend a lot of time with the kids. We have a 1.5-year-old now, and we have another one due in about a month and a half. So for me, I would wake up early before the wife and before the kids. I would do the Miracle Morning Routine, which I'm not sure if you ever read that book.
Yeah. I mean, I've actually got like a Miracle Morning for Real Estate Investors, little PDF that I wrote.
Nice.
So if you guys want that, let me know. It's one of the free gifts that I have. I was saving it for Christmas, but you guys can have it early.
Nice.
Yeah.
So I do my meditation. I do a 1 hour workout. Then when the kids and my wife wake up, we would probably go do some kind of activity, something outside. I also think, which with our long-term goals being to have a lake house, I definitely want I want a fixer-upper lake house, and I want our next primary residence to be a fixer-upper. And in my, ideal world, by that time we've reached our cash flow number, and I would basically spend my time, working on my new lake house and working on my new, primary.
Cool.
primary house.
Cool. So when you do have all that cash and you're looking to burn it, what's something that you kind of recently burned your cash on for a time savings or improvement quality of life?
Yeah, so I would say what I didn't directly burn cash, but I burned the opportunity to earn more cash. And that was when I decided to not work on Fridays anymore. So I just work. So when I am working, I just still work 4 days a week. And that's so I can have Fridays with my son. And that has absolutely worked wonders. It feels so good to have that whole day with like just me and him, and there's no other distractions or anything else going on. It's just me and him on Fridays. So that's been awesome.
Yeah, I'm gonna go some basic commentary here. Why don't you go with a Monday? Because I'm gonna go switch to 410s here.
Yeah.
And I'm gonna take Monday off because Mondays suck. But what was your thoughts there?
So Fridays are easier to take off as a consultant because typically we work from home on Fridays. So we were traveling when I was traveling, it was Monday through Thursday. So think about like if I'm on a project and there's another consultant who travels in Monday through Thursday and then they leave on Thursday. It makes a lot more sense for me to be on site the same days as them.
Got
So
it.
that's why Fridays.
Got it. Yeah, I mean, it makes sense if you have that day off. I mean, you're gonna use it with your kid, but I'd probably use it to catch up on work before the weekend to get the work done first.
Yeah.
I know. Basic questions.
Yeah, I do some. I definitely do work on the business on Fridays as well. I've spent time, but I take my son everywhere, right? Because I can't
Yeah,
leave him.
I mean, you save on like what was it, daycare, right? Too, by
Right.
not having that.
Yeah, but I mean the money that I could be making on Fridays would be so much more, than the cost of
Right.
daycare.
All right. Something that you recently changed your mind on as an investor.
Yeah, so I would say what I changed my mind on is when I first got into real estate investing, I I thought of it as much more passive, and that was kind of what I was working towards. But then, kind of like it's just my personality. I like to have a little bit more control, and I found that I've been having a lot more success when I've been kind of doing the Burr model lately, where I'm the one finding the deals, I'm the one finding the contractors, I'm the one managing the rehab, and then I hand it off to my property manager. So I would say that's kind of what I changed my mind on, is kind of like how active I wanted to be in
Right.
that business.
Right. And that was actually the next question, was like, more going out to more the newer investors with the seller's market and things how they are. You kind of
Right.
mentioned that the burst strategy is kind of the way to go. But what would you say to like a complete newbie? Do they kind of dive into the deep end of the pool with this stuff and do the burr, or what would you recommend to like a buddy trying to get started that don't have the quite time to hold their hand?
Right. I would definitely not recommend jumping into Burr. I mean, there's so many other things that can go wrong. I would say if you have the money, go ahead and buy Turnkey. Whether it's buying from a turnkey company or just buying a property, near you that cash flows, that's relatively in good condition. Either that, or if they don't, if they need a place to live, they could buy a house hack, which is where you buy a multi-unit property and you live in one of the units and you rent out the others. So that's what I would say.
Right. So sorry, new guy. Your work is kind of cut out for you. Yeah, but I mean, that's the thing. You got to fight through that initial point. I always use the metaphor, that little cute sea turtle. Like, you always see that video of when they come out of the sand trying to make their way to the water. Everybody's trying to like poach on them, and all the seagulls are trying to eat them. All the sharks, right, and they get in the ocean,
Right.
trying to eat them, and that's kind of indicative of all the shysters out there and all these, these bad properties that are being put around for mostly for Californians that don't know any better.
Yeah, exactly.
It's hard, but you got to fight through.
Yeah, and the other thing is there's just so many people looking to get into real estate right now. So you really do have to be careful. You don't want to just get swept up. So you want to make sure you're thinking all the time about like, um, does this property actually cash flow? What's my exit strategy? And you want to make sure you vet, whoever's going to be selling it to you or managing it for you.
Right, right. All right, well, we made it to the end here, and this is the Tony Robbins question. He talks about the science of achievement and the secret to the art of fulfillment. So let's break it up here. What is your secret or hack to the science of achievement? How do you get things done? Any secret habits or nighttime rituals, morning rituals? I mean, you said you do the miracle morning thing, but any other quirky items?
Yeah, I don't know if I have anything quirky. Kind of my answer to this is that I try to be strategic in everything that I do. So some people might think that I'm taking all kinds of risks and that I'm like a real estate cowboy riding in here and buying properties for cash and, rehabbing them. But I'm constantly, everything that I do is I say, okay, if I buy this property in this location and I'm trying to refinance it, like, what if I can't refinance it? What if the rehab goes wrong? What if I can't find a tenant? What if the rents drop 20%? What if I have a 6-month vacancy? So I'm constantly thinking about what would happen if all these different things happen, and just having a backup plan in place for all those things. And I think if you've constantly thought through all those and you have a plan in place, then you can be a lot more confident. And then you can, when that deal comes up and it's met all your criteria and you have multiple backup plans in place, then you can act.
Right, right. It's like when you're seeing 11 come up on the blackjack table, you double down.
Yeah,
After that.
yeah, exactly.
Cool. So your secret or hack to the art of fulfillment?
Okay, so I would say the way that I do this is I just act with integrity and honesty in everything that I do. So in like building a team, finding contractors, finding property managers, even like the few times that I've dealt with tenants, like I want to make sure that I'm treating people how I would like to be treated. And that just it just comes back to you. So, if you build the right team, you treat them right, they're gonna treat you right. And then, that's what helps you kind of feel good at the end of the day.
Right, right. It's one of those things, like self-awareness is one of the biggest traits I think you can have, because if you have that, you can keep course correcting. It's always funny seeing these guys, like, they're always nickel diming people. and I know that's what they're doing with their vendors.
Right.
And then come to find out 6-12 months later, it seems like they're kind of struggling with their portfolio. They're getting
right
quotes. And I'm like, yeah, because you're like dicking everybody around. Nobody likes you. Nobody wants to help you. You're a taker,
Right. Yeah, I've got my contractors, if I don't have a deal, they're texting me and saying, hey, I want to do another deal. If I don't have a deal, my property manager's texting me and he's saying, hey, I want to do another deal. Can I help you find a deal? Like, these guys want to work with me, and that's exactly the kind of team that I'm trying to build. I want people who are eager to work with me. I don't want to be a burden to them.
Right, right. I mean, the point is, like, when you get to a certain point where you're pretty well networked, everybody. The only difference is like who's less of a pain in the ass, or even more, who's more fun to work with.
Right.
So I think the guys got a lot of value out of this. If you guys, there's some other reading, SimplePassiveCashflow.com/turnkey, where I kind of compiled all my turnkey stuff before I forget it in that article, and then the Analyser, and then also check out Kyle's website, ReallifeRentalscom. he does an absolutely great job of like tracking the monthly portfolio performance. And you know, I mean, something that I just never had the time for to do, nor yeah, I mean, it's kind of painful to do that, but I appreciate, you know, you
It is
putting all that
painful.
up online. Anything else, you know, any last messages for the newer folks trying to get into rental properties?
Yeah, I would say, you know, my main message for newer folks is, you know, definitely read all the books, listen to the podcast, but at some point, you know, you've gotten enough information from the books and the podcast, and at some point you just have to act. So I would say, you know, try to be aware of what that point is where it's time to actually take action.
Cool, cool. Well said, well said. All right, Kyle, well, thanks for jumping on. We'll keep in touch, man, I'm sure.
All right, sounds
Yeah.
good. Thank you.